Here's something that might shock you about UK house prices right now. While everyone's talking about the market slowing down, we've actually got a tale of two completely different stories happening at the same time. And if you're thinking about buying, selling, or just curious about where your biggest asset is heading, what I'm about to share could change everything you thought you knew about the current property landscape. I'm going to break down exactly what's happening with UK house prices today, why the experts are getting it wrong, and what this means for your money in 2025 and beyond. But first, let me show you why the numbers everyone's talking about don't tell the whole story. Right now, we're seeing something fascinating in the UK property market. Halifax says house prices dropped by 0.3% in September, falling to an average of £298,000. But here's the twist. Nationwide, using their own data from the exact same month, says prices actually rose by 0.5%. Two major lenders, same month, completely opposite results. This isn't just a small discrepancy. This tells us something crucial about how confusing the current market really is. Each lender only looks at their own transactions, so they're essentially looking at different slices of the same pie. It's like trying to understand the weather by looking out of different windows of the same house. But here's what both datasets agree on. The market has essentially flatlined. We're not seeing dramatic crashes or explosive growth. We're in what I call the Great Stagnation, where prices are barely moving in either direction by even 1 percentage point monthly. Now, let's talk about what's really driving this uncertainty, because this is where it gets interesting. The upcoming autumn budget has created a perfect storm of hesitation. Property experts are calling it a repeat of last year's guessing game about tax rises, and it's already having real consequences. Here's a number that should grab your attention. In the luxury market, where homes are priced above £500,000, buyer demand has dropped by 11% in just 5 weeks before late September. New listings in this segment are down 9%. This isn't gradual decline. This is people hitting the pause button hard. But it gets more specific. There are rumours swirling about a potential property tax replacement that could target homes above £500,000. Whether this actually happens or not, the mere speculation is enough to freeze parts of the market. It's like watching economic psychology in real time. The regional story is equally fascinating and reveals some surprising winners and losers. Northern Ireland is seeing the fastest annual price growth at 5.5%. Scotland comes second at 3.3%. But London, the traditional powerhouse of UK property, is crawling along at just 0.7% annual growth. Within England, the North East is absolutely flying with 7.9% growth, while London struggles. This regional flip tells us something profound about affordability and where people can actually buy homes versus where they want to live. Now let's dive into what the forecasters are saying, because this is where the story gets really compelling. The Royal Institution of Chartered Surveyors recently showed that confidence in the housing market dropped in August. Even though agents still expect prices to grow over the next 12 months, they're less confident about this prediction than at any point since December 2023. Major forecasters have been slashing their predictions. Savills cut their 2025 growth forecast from 4% down to just 1%. Knight Frank made an even more dramatic revision, dropping their 2025 forecast from 3.5% to 1%. These aren't small adjustments. These are major course corrections from firms that stake their reputations on getting these numbers right. But here's what's really interesting about the current situation. Despite all this uncertainty and slow growth, average property prices are still hovering around record highs. The average UK property costs £270,000, according to official land registry data. That's about £8,000 higher than a year ago. This creates a paradox. Prices aren't falling dramatically, but they're not rising quickly either. We're in this strange middle ground where affordability remains a massive challenge, but there's no crash providing relief for buyers. Let's talk about asking prices, because this gives us a real-time snapshot of seller sentiment. Rightmove data shows asking prices are actually 0.1% lower than a year ago, despite rising slightly in early September. The typical property is now listed at £370,000, about £500 less than September 2023. Here's where it gets geographically interesting again. Southern England has a glut of properties. The number of homes for sale is 9% higher than a year ago, compared to just 2% elsewhere. This oversupply means it takes an average of 5 days longer to find a buyer in the south compared to the north and Wales. This is creating what experts call a buyer's market in many areas. Sellers who reduce their price expectations over the summer are creating more realistic conditions for sales. It's a classic case of market forces working, but slowly and unevenly across different regions and price points. Now, what about interest rates and borrowing costs? This is crucial because it affects everyone's buying power. Fixed mortgage rates have eased slightly from last year's peaks, but borrowing costs remain significantly higher than what buyers faced just a few years ago. This is keeping many potential buyers on the sidelines. However, there's an interesting development here. Following encouragement from policymakers, some lenders are allowing mortgage customers to borrow more than they could previously. Under old rules, less than 10% of new mortgages exceeded 4.5 times a borrower's income. The Bank of England recently said it would be happy to see that percentage rise to more than 15%. Nationwide says this means applicants can now borrow £28,000 more on average. This could potentially offset some of the impact of higher interest rates, though it's still early to see how this plays out in practice. Looking beyond 2025, the forecasts become more optimistic, which is fascinating. Despite cutting their near-term predictions, Savills is forecasting 4% growth in 2026, 6% in both 2027 and 2028, and 5.5% in 2029. They expect wages to grow 22% between 2025 and 2029, combined with a strengthening economy. Knight Frank has more conservative but still positive longer-term expectations, forecasting 3% growth in 2026, 4% in 2027, 4.5% in 2028, and 5% in 2029. The question is whether these longer-term forecasts will prove accurate. A lot could change between now and then, including interest rate expectations, the health of the UK economy, and government policy changes. Speaking of government policy, the potential for stamp duty replacement remains a wild card. Speculation includes replacing stamp duty with an annual property tax for homes worth more than £500,000, ending capital gains tax exemption on first homes above certain thresholds, and potentially hitting landlords with national insurance on rental income. Whether any of these rumoured changes actually happen remains to be seen. The Treasury hasn't confirmed any property tax changes for the autumn budget, but the mere speculation is already impacting market behaviour, particularly in higher value segments. Here's my take on what this all means. We're in a unique moment where multiple forces are pulling the property market in different directions. Affordability challenges are real and persistent. Regional variations are more pronounced than we've seen in years. Policy uncertainty is creating hesitation, particularly among higher value buyers. But underlying demand remains, supported by population growth and household formation. For potential buyers and sellers, this creates both challenges and opportunities. Buyers in many areas have more negotiating power than they've had in years. Sellers need to be realistic about pricing, particularly in oversupplied markets. And everyone needs to focus on their personal circumstances rather than trying to time a market that's proving remarkably difficult to predict. The UK housing market isn't heading for a dramatic crash, but it's also not returning to the rapid growth we saw in previous years anytime soon. Instead, we're entering a period of what I'd call mature market behaviour, where local factors matter more than national trends, and where patience and realistic expectations will be rewarded more than speculation and rushing. What's your take on these housing market developments? Are you seeing these trends play out in your local area? Drop your thoughts in the comments, and if this analysis helped clarify what's happening with UK house prices, hit that subscribe button for more property market insights and financial analysis.